The stock market, also known as the share market or equity market, is a platform where buyers and sellers trade shares of publicly listed companies. It provides a marketplace for companies to raise capital by selling ownership stakes in the form of shares, and for investors to buy and sell those shares. Here's a simplified explanation of how the stock market works. Companies go public. Companies issue shares to the public through an initial public offering, IPO, or other means. By doing so, they offer ownership in the company to investors. Exchanges and indexes. Stock exchanges, such as the New York Stock Exchange, NYSE, or NASDAQ, provide a platform for trading stocks. They have listing requirements that companies must meet to be listed on the exchange. Stock indexes, like the S&P 500 or Dow Jones Industrial Average, track the performance of a specific group of stocks. Buyers and sellers. Investors can buy and sell shares through brokerage accounts. Buyers aim to purchase shares at a lower price and sell them later at a higher price, generating a profit. Sellers, on the other hand, may sell their shares for various reasons, such as taking profits or cutting losses. Order types. Investors can place different types of orders when trading stocks. The two common types are market orders and limit orders. A market order buys or sells shares at the current market price, while a limit order sets a specific price at which an investor is willing to buy or sell. Supply and demand. The stock market is driven by the forces of supply and demand. When more people want to buy a stock than sell it, the price tends to rise. Conversely, if more people want to sell than buy, the price tends to fall. News, company performance, economic factors, and investor sentiment all influence supply and demand. Market participants. Various participants, including individual investors, institutional investors, such as mutual funds and pension funds, traders, and algorithmic trading systems, engage in buying and selling stocks. These participants contribute to the liquidity and overall dynamics of the market. Stock price fluctuations. Stock prices are subject to fluctuations throughout the trading day. These price movements can be influenced by news events, company earnings reports, economic indicators, geopolitical factors, and other factors that impact investor sentiment. Risk and reward. Investing in the stock market carries risks. The value of stocks can go up or down, and there is no guarantee of profits. Investors should carefully research companies, diversify their portfolios, and consider their risk tolerance before making investment decisions. It's important to note that this explanation provides a general overview, and there are many complexities and nuances in the stock market. Investing in stocks requires careful analysis and understanding of the companies and market conditions. It's recommended to consult with a financial advisor, or do thorough research before making investment decisions.